So for equity, we did a syndication with high net worth investors, families, friends. I think we ended up with 14 total investors, um, including me.
Yeah, and actually that's one thing that I'm is really cool. It ended up where everybody who worked here invested money in the deal,
hmm
and some of them their parents did.
Yeah.
So then like that's really cool. I would have never thought that would have happened. And not it's really says something about the deals where people are working on it, or like you know you're modeling the deal, you're doing it, and then the guy sitting next to you is like, hey, we should get like money in this and like get a share. And same thing with just so it's interesting to see where yeah, so out of the 14 investors, I mean, six, five or so of those were the deal team, so that's um interesting to see play out. I'm proud of that.
I'm Drew Breneman, and this is the Rise and Invest podcast. I bought my first two properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor.
Welcome back to the Rise and Invest podcast. I'm Drew Breneman. We just closed a new deal this week, and so we wanted to hop on here and do a deep dive, talk about the deal and how everything went down. And so today joining me is Dillon. He's the vice president at Rise Invest, and he was able to source this deal and take it soup to nuts on his own. So I wanted to get him on here and chat about it.
Yep. Soup to nuts. Good to be back on. Good to talk about the deal. And my first deal that I ran the whole process with you. So it was exciting, some minor mistakes along the way, but from initial underwriting to sourcing to PSA and LOI negotiation to the due diligence and closing process, it was a lot of fun. It was a learning experience, and I think we got a good deal. So let's talk about it.
Yeah, definitely. And I think maybe one thing before we dive into the deal, I just want to mention. I know it's in the outro, but I don't think I've ever actually talked about it on the podcast. But on our website, if anybody's interested, we've got like a ton of written resources. So if you're into more just reading something on your own, we've got a blog on there, and also we wrote a kind of all of us at the company. I wouldn't want to say I wrote it all the way. I mean, Evan wrote a huge chunk of it, and so did a lot of the other people. 100+ page guidebook. That, I mean, even putting it together, I think even all of us learned something. I know I did, but it's really geared towards passive investors, kind of explaining what all these terms are in deals, and then just kind of what to look for in a sponsor. There's so a lot in it. Obviously, if it's 100+ pages, so if anyone's interested in that or our blog, it's all on our website, so you can go to it. It's riseinvest.com, and then also there you can sign up if you're interested in investing in our deals. You can sign up there as well. There's a button in the upper right, can't miss it, right there in orange that says invest now, so you can sign up to be an investor. You're just putting your name in, basically an email and a couple other pieces of info, and then you get sent deals when they're available. There's not always a deal available, so you might sign up and there's not anything to look at yet. We could send you like a past deal or something, but usually when we get it to a point like what we'll talk about here, once we know we're gonna move forward with it, then we usually send it around. So that's how it works. And then cool, where do you want to start us off on Huntington then, Evan?
Yeah. So the deal, 20 at Huntington, it's a 20 unit value add deal in Tempe, Arizona. We purchased it for 5.7 million. And yeah, the building was built around 1970, 20 units, like I said, 4 1-bedroom, 1-bath units, and then 16 2-bed, 1-bathroom units. We bought it from we'll call it like a high net worth investor who has a little bit of a track record of doing these smaller deals, doing some renovations, and she did a really nice job with the renovations. I think, out of the 20 units, about 7 of them like received like a full cosmetic renovation, quartz countertops, vinyl flooring, updated electrical and plumbing fixtures, stainless steel appliances, new paint, new tub, and like new like tub tile surround. So, it looked really good. And then, there were about 12 units that I guess we could call it, partial renovation, where the seller, may have done some renovations herself, or the previous owner before her, did some things where, we had a mix of tile and vinyl flooring, um, mostly older cabinets that were painted, and then, some new sinks with gooseneck faucets, some backsplash, things like that. But, um, and then, one, I guess we'll call like classic unit or original unit where, the countertops and floor and cabinets and appliances, it kind of looked like original with the building. So, you know, um, a nice mix of, I guess meat on the bone left, as we'll call it, where, we can still come in and like add value beyond just the units that were renovated. We have 13 units where we can add some value and do some renovations. Um, and then the seller, they also did a nice job of like just cosmetic renovations on the exterior, nice modern paint scheme with like white and charcoal and sage green, really looks nice from like a curb appeal. And, I think that goes a long way in just inviting new renters to, attract attention. I mean, just you walk down the street and you see a new or a building that you walk by every day, and then one day it's painted, you say, oh, that looks really nice. And, it makes a big difference. And then, some amenities like a pool, some covered parking, which is important in Arizona because it gets to be above 100 degrees. Probably what,
Yeah,
two
in
200
April.
days.
Yeah,
Yeah.
starting in April. I was just talking to one of the gals at the title company, and I was asking about the weather, just to kind of whatever, something to talk about. And she was like, "It's already too hot." And it
Yeah.
was because at one point I looked on my phone and it was 27 here degrees and then 72 there. So that's why I told her, I'm like, it was the numbers were flipped.
Yeah.
And she's like, "When was it 72? It's 92 right now."
Yeah.
And I was like, "Dang, it's
Yeah.
still." I
I
think I
think,
was talking to her in March.
yeah. And I think we were there in October and it was like 105 degrees. So it stays hot
Yeah.
there. So the covered parking is, that's a big deal. And then, nice location. So it's located in Tempe, like I said, about a mile and a half south of Arizona State University and downtown Tempe. So good central location. You can get to downtown Tempe in about, 10-minute drive, and then probably like 20-minute drive to either downtown Scottsdale and downtown Phoenix. So, you know, close to everything. Good amenities nearby, some good grocery stores like Fry's, Sprouts, Arizona Mills Mall is pretty close by as well. And this is also, a section of the city that's not seeing a ton of new supply being delivered. This is the 85282 zip code, and I think, we have about 6 units per 1,000 people under construction right now. So nice infill locations. We don't really have to worry about comparable product being built up. And that's good for us. That's good for rents. That's good for doing the value add.
Right. Great. Well, yeah, you want to dive into then like what's our business plan then with it?
Yeah, sure. So, like I said, um, you know, a number of the units were fully renovated. A good chunk of those, it's something that we I guess don't see too often, but it pops around. Some of the units were actually leased to tenants who were using them for short-term vacation rentals, like Verbo or Airbnb, and we plan to eventually turn those over to just regular apartment, traditional apartment leasing to just single tenants who aren't necessarily using them for short term vacation rentals. But that wasn't an issue with our lender, that this was occurring, that they had these units being leased to short term vacation rentals. Some lenders it could be an issue, like Fannie Mae, Freddie Mac. I don't think they like that. Um,
Right. One thing I always preach and talk about is always think about your exit. And so on this deal, like to sum up our business plan, on one hand, we're buying a deal that was like this halfway renovated through being like a full, completely renovated deal. So we're going to finish the renovation, and then in my mind, like the buyer, when we go sell, it's going to be to somebody from like California who wants a long-term hold. The deal's fully cleaned up. all you got to do is buy it and just run it, and
Mm-hmm.
it's easy to do from far away, just as an individual, if it's like that. And it's the same thing on with the Airbnb comment, because right, if you're gonna rent to Airbnb tenants, a lot of the non-recourse lenders like Freddie, Fannie, a lot of these debt funds, which this deal would be too small for a debt fund, but just they would be included to life insurance companies. A lot of them right in their loan docs, it says you can't rent to anybody who's doing like short-term leases or
Mm-hmm.
would rent to a company. That's another way they block it. Like if you the Airbnb operator, eventually they're going to want to sign the leases in like a LLC or some sort of business to not have all that personal liability. But then that's so they block it a lot of ways. But point being, why would you want to limit your buyer pool at the end if someone comes through and they're willing to pay the most, and then they look at it and go, wait, I can't get the loan I want anymore. I really like to use
Mm-hmm.
Freddie Mac for these deals. I mean, you're going to end up getting a lower price, unless the rent was like so much higher off the Airbnb part that then you could offset that somehow when you limit your buyer pool. So, but yeah, on the front end, definitely not an issue for us. It's one nice thing about using a bank where we just explained what
Mm-hmm.
is happening and I asked them right away. I always find that's better too, as like another tip. Like if you see this, you should just ask in the front end, especially with lenders. Like they want to make the loan, they want to have the business. They're way more flexible on the front end. Where who knows, maybe if we would have asked, can we do this like a year in, they'd say, oh no, we don't like that.
Mm-hmm.
But if you can make a whatever, $4 million loan, and just you're couple okay with some Airbnb units, now you can make the loan. So that's another tip too. Just be transparent, and then also a lot of these people that are in it's kind of a sales role, they'll be your advocate, especially on the front end when they need to produce the business.
Yeah, yeah, that's a great point. And real estate by itself is already one of the most illiquid assets out there. I can't just go on that stock exchange and
Right.
buy a couple shares of some property. So anything that makes it even more illiquid like that, you know, that's gonna be a damper on your exit price. So yeah, that's a good point. Um, and just kind of tailing off that, we would go in and then renovate the rest of the units, so the partials, and as well as the classic unit, to match the full renovation spec as those the full cosmetic renovations that the seller had done to those 7 units. So I think at least for the 2 bed 1 bath units, the last 6 or 7 leases were signed at like 1750, and then for the 1 bedroom units, we had a few leases signed at like 1500. So made sense. That's the rent, and we wanted to add in washer dryers as well. Um, One thing that I forgot to mention is that the property also has like an on-site laundry facility with two washers, two dryers, nothing special. So having that personal washer dryer in your unit, I mean that's a nice value add, and you can definitely get a good premium on top of that. So I think we budgeted like another $75 or so on top of that, and getting to rent about 1600 for the 1x1s, and then 1850 for the 2x1s. So that's kind of what we underwrote. And pricing guidance was initially high 6 millions. But I was talking with the broker, and he's saying, I think the seller is pretty motivated to sell. She wants to do a 1031 exchange. So she wants to just sell this and get into a new deal, and let's see if we can get something done. So I think we entered it something in the low 6 millions into our model, underwrote the deal, and it looked pretty solid. So we made it a point to go out to Phoenix to tour the asset and see it live and in person. And it looks solid. The renovations were really well done. It's a good location, infill Phoenix. Like the deal, and like it had a really strong cap rate. One of the things though that was peculiar about the deal though was that it had been on the market for a few weeks now. And at this point in time, Phoenix is the most liquid it ever had been as a market. In terms of like 2021 sales, I think it was the most in the decade, just by number of units that have been traded.
Yeah, I'm not surprised.
Yeah. So it's kind of peculiar that, like, why hasn't this thing traded, I would expect, this to be under LOI within 2 or 3 days of the listing. Um, and, it kind of clicked for us when we realized that the tenants who had been leasing the units to use for Airbnbs and Verbos, um, they were actually above market rents, because it's not necessarily something that you see around pretty often. You underwrite 20, 30, 40, up to 300 unit apartment deals, and the significant majority of them do not have this Airbnb tenant in place, right? So when we did a little bit more of a market survey, we were seeing that this 1750 for a 2x1, it's really nice quality renovation, but it's above market. So when we realized that, we made it a point to adjust our rents to, because we're eventually going to lease these to traditional apartment renters. So we wanted to adjust those rents. And I think we settled on 1550 for the 1x1s, and then 1725 for the 2x1s. That's fully renovated with in-unit washer dryers. So make that adjustment, and it's a pretty significant impact to the value. And I think this is like a really important thing to bring up because, we had underwritten it with these higher rents, which were being achieved at the property. So the deal looks really great on a cap rate basis, but, it kind of clicked for us, and, why it wasn't traded, because these rents are above market, and people may be looking at this deal on a per unit basis or a per square foot basis, like in terms of like purchase price. Um, so they might not be attributing that value to those rents. And I think that's important for not only multifamily, but all types of real estate where there's a lot of nuances and like hair, we'll call it, with deals where there might be an underlying reason why rents may be above market or below market. And that's important to, discern and like figure out while you're doing the underwriting process, because there's, a chance that you could be overpaying for something.
Right. It's yeah, I think it's real important to look at the deal a lot of ways. Like you're
Hmm.
going in cap rates is one metric. But yeah, if you're buying like a shopping center and half of it's leased to Starbucks at something that's, $45 a foot or in rent in a market that's 25 a foot, yeah, your cap rate's going to look amazing because a lot of buyers are going to go, okay, what would this be worth if Starbucks leaves? I'm going to re-rent this thing at $25,
Hmm.
when it goes to market, and that's, going to chop that value of that space roughly in half. So I think it's really important to look at these deals a lot of ways, like Evan's talking about, and one of them really would be what is this thing worth just at market rents today, and that's what you're describing, where we're going. The market rent probably isn't quite as high as the Airbnb person's paying at the moment, and I've seen that plenty of times because there should be, if you are, let's say you're asking 1750 on this deal and then you're not getting it, well, let's say from just regular renters, then your rent's above market. Usually it's just the price. I mean, assuming there's not anything wrong with your advertising if it's not
Hmm.
renting. And then an Airbnb person comes by and says, I'll take them. I mean, then they're kind of paying over market, but they got it. And the landlord goes, this is fine now because I'm getting the rent and it's worth the extra hassle. But it's, so at first we didn't have that figured out till we did our rent study, and then it all sort of came together. So yeah, good point. Want to reiterate that and looking at sort of it from a market rent today standpoint, because that's especially common in retail, these other product types where certain tenants can pay more,
Hmm.
especially in the commercial space. Because in a business, like your rent, depending on the type of business, it's I mean, I guess this could be really low in a grocery store, but let's say it's like 3% to 20 some percent of their overall costs are the rent. So if you really, really want to be on a certain spot in your Chipotle or whatever, let's say in retail, you can pay up because that might just be, 10 or 15% of the cost of the whole store. So even if you paid 50% more than market to get that end cap, the corner you want, it only moved your costs up, whatever, just the 50% more on the 15. So it's not, it bumped it up into the 20s, I guess, but it
Hmm.
didn't. You should have like a commensurate sales increase then. So,
Hmm.
but yeah, good point. And yeah, especially important today with rents moving around so much on all product types. So,
Hmm. Yeah. Yeah. So, we had initially circled low 6 millions for this property. And yeah, obviously, the change in market rents that we had set. Uh, that was a significant impact to the valuation. So we ended up lowering it, and we still thought it's a good deal. We're not going to be going in at a purchase price necessarily that's going to uh, wow the seller, but um, yeah, so we lowered our valuation to 5.7 million, which was ultimately our purchase price. And I kind of discussed this with the broker, saying that like, hey, I had originally thought maybe we could get something done at 6 million or maybe a little bit above that. But this is what we're seeing in the market rents, and I think that's important to discuss that with the broker rather than just throwing in an offer that was well below what the initial guidance was, because maybe they think that you're just throwing in a low ball offer.
Right. And this was our initial offer because you said we dropped our price. That was really just in our model, right?
Correct.
Okay.
Yeah, correct.
And then because originally and did you tell him you thought I'm going to come in the low 6 millions? And then this conversation you had was, we actually can't. This is where we're coming in, or
I think it was an initial discussion where he had given me guidance in the low 6 millions, and I said, hey, it looks pretty good. We're interested in seeing it, so we're gonna go down to Phoenix and check it out. But I'd never said fully that like we're in on the deal for 6.2 million or whatever.
right?
Yeah. But yeah, we ultimately, put in an LOI at 5.7 million, and we held firm, and we kind of saw how motivated the seller was. Because within a few hours, I think we received a counter at 6.3 million, which was the initial guidance that we had received. But we didn't get emotional about the deal. We set a price that worked for us. We're not going to reach for it when we think it's there. We're going to hold firm to our valuation because, the seller might have one idea for what it's worth, but, we have our idea, and we have investors, and we want to make sure that we're paying market for a property. So, we stayed at 5.7 million. The seller countered at 6.3 without, engaging in, any sort of, counter ourselves. The seller actually countered themselves again and lowered their price to 6 million. So they said 6.3, then they went down to 6 million, and we didn't budge. We still didn't get emotional about the deal. They still went down 300,000, which is, a pretty good chunk for one of these smaller deals, but we didn't move. And then I think 1 or 2 weeks later, the seller actually counted themselves a third time down to 5.7 million, which was our initial offer. So they said, take it, or we're going to call for offers. And at which point we said, let's do it.
Yeah, and it's a great learning lesson here, and even for me, because what's interesting from my perspective is I can say for sure, and I don't think I told you this before. If I just was still working just on my own solely, I wouldn't have bought this deal.
Mm-hmm.
Not because I don't like the deal, just because I would have underwrote it and said, I'm at 5.7. This broker's telling me the ask price was 6.7. Now it looks like it might go for 6.3. I'm like more than 10. I'm like 10% off that. Like, I'm not going to get it. This is the hottest market basically in the entire country. Like, stuff selling, similar. The same brokers had a similar deal. Obviously, there's a different, income and unit count because the price will be different. But they were doing the same thing on another one. The whisper price was like 9.5, and then by the time we asked the second question about it, it's like, oh, it's already gone.
Yeah.
We got like 3 offers around that,
Yeah.
so it's gone. And then you're doing a call for offers, like, well, we don't need to. We already have a feeding frenzy on it.
Yeah.
Like that's. So then we're hearing that, and we're like, okay. So I probably would have stopped on my own then, said I got to spend time on something else.
Mm-hmm.
And Evan stuck with it, where originally I thought we were actually underwriting it. We had to have been underwriting it higher than 5.7 because we've never before, just at least that I can remember, offered here's our best number first. So then I think what we were doing was our rents. We originally made that 5.7 offer when we thought the rents might be $25 higher, thinking, okay, maybe we'll get to like 6 million or something. This is what I'm remembering. You can tell me if this is wrong, and then the more we studied the rents, we're like, actually, this should be $25 less. Kind of made 5.7 our best offer then at that point, actually.
Mm-hmm.
Which then So to me, I'm talking to you and I'm going, this is kind of a waste of time now, Evan. Like we're trying to do larger deals too. At the same time we're buying something that's we're looking at deals that are 30 million, 20 million, 40 million, and we're spending all the time back and forth on this, $6 million deal. Like let's just, we're not close on price. Like let's forget about it. And Kurt Bender was on the podcast and he talked a lot about this, that he always throws in an offer on every deal, just where he's at. The brokers like getting the offer, and then he gets a lot of what he call rebound deals, where fine, someone starts out at a higher price, then something happens, they cancel it, and they kind of then go back down through the people who made an offer.
Mm-hmm.
And I would have to really think if I ever got a rebound deal. Like I'd have to think about it. I don't have one off the top of my head. Not in a marketed situation, an off market thing I have where it was like someone was at this price, they're not closing. Could you do it close to that? I've gotten those, but not in the thing like Kurt was talking about. So I learned on that podcast from Kurt, and I learned on this deal too, because then what ended up happening is you stuck with it. And, since 5.7 ended up being our best offer, we just kind of, the term is hanging around the hoop. Sam Zell says that a lot, and it's, definitely right, because it worked out on this, or we didn't say, never mind, stop calling us.
Yeah.
It doesn't sound like 5.7's a deal. We just kept saying, hey, we want to buy it. We updated our rents and we made like 5.7 our max. Like we would like to buy it though, if we could get it. And and it worked out. So, I mean, this was something where I would have just cut it if I didn't have I wouldn't have had the time to do this. So it's exciting kind of as a platform. We're able to put this together as a team, because then I would have not had the time. I would have been like, I need to spend time on something else, or, I wouldn't have, it would have just kind of fallen by the wayside.
Yeah.
But we just continued to hang by the hoop. And then it's also really rare for people to counter themselves, but if, they started out at too high of a price, that kind of must have been a turnoff or something for people. And then we're just guessing now at this point, but there was less engagement in it. And then it's hard to get people to re-engage. And then now I don't know, at that point, maybe the only people at the table. A lot of people too, they're waiting for a call for offers date on these, and they didn't have, they were not sure, is my recollection, if they're going to do a call for offers or just field them as offers come in and respond. So that's why we offered early. So maybe some people were waiting for a call for offers. I don't know.
Yeah. And I think you kind of touched on this, but before we talked to the broker and he said maybe a deal gets done at low sixes, he said that the initial guidance that they went out with was 6.7 million. That's what the seller wanted. And you kind of touched on this, but someone might see that and call up the broker and ask what guidance is, and they say 6.7 million. That's really high. They might say this deal is not worth it. I'm going to focus my time on other things. So you're already starting at a smaller buyer pool who thinks this property is overpriced. So they might divert their attention to something else. And I think we kind of see the opposite when a property has guidance that is below what we think it's worth. Then we'll see everyone pulling in, and then the price shoots up.
Yeah.
So it's kind of a an interesting dynamic where it really depends where initial pricing guidance comes in terms of like what your buyer pool really looks like at the end of the day.
Yeah, that's definitely right. And we're kind of just speculating too on how this played out, but because the broker on this is really good, so it wasn't like it was like, oh, if a different company had it, it would have gone differently. Like this is a really good broker, and they make a big difference once to get the highest price and then to keep deals together. So it definitely wasn't that.
Mm-hmm.
So maybe talk about like the returns, or where do you want to go next?
Yeah. Yeah. So, returns wise, I think we were going in at a cap rate of about like 4.7, and with the value add, we were going stabilizing to like a 4.9, which doesn't seem like that large of a spread because it isn't. But we're attributing a decrease in rents because of those Airbnb units having larger rents than market. So there's a bit of a correction there. But just looking at the in-place cap rate by itself, that's very, very strong for this market of 4.7. Whereas most deals are, low 3 cap deals, especially for value add, where, you really need to come in and not only mark rents to market, which most of these deals that we underwrite are 20-30% below market. Um, and, this deal was going to be cash flowing from the start, which was attractive. We had budgeted about 400,000 in total capital improvements, ranging from, the interior renovations, adding in the washer dryers, taking care of, some deferred maintenance, and, having some contingency in there as well. So, I think we saw that similar product, 70s, 80s vintage type stuff, fully renovated, smaller property, well located. Um, Most of those types of deals were trading in the low 4 caps, so call it like a 4.3 stabilized cap rate. So on a like a as stabilized today value, snap your fingers, all the renovations are done. We add in the washer dryers, we take care of any deferred maintenance. Our stabilized today valuation was about 7 million. So we'd be creating about 1.3 million in value through our strategy, which is pretty nice. And we underwrote to a 3-year hold, a 4.3 exit cap rate, and that ended up equating to about 10-11% in annual asset appreciation. And one of the studies that we had done was examining like the appreciation rate of all multifamily properties in the market by looking at all the transaction data through Yardi, and from there we could look at, the same property had traded, several times, throughout the last 10 years. And we can actually measure the actual price appreciation annually. So the market actually, it's averaged, 14% from 2013 to 2019. So our underwriting of 10 to 11% felt pretty on par with where the market has been. And then we also assumed 5.4 percent rent growth in years 1, 2, 3, and 4. And the market's averaged over 5% over the last 15 years, and I don't think market rent growth has been less than 5% since 2012, according to Yardi. So we felt that assumption was about in line with where the market was at. And we also ran our own AI rent growth. We use our AI rent growth model to assess like this zip code as well. And, that looked really strong as well. And like I said, it's infill location, not much new supply in the pipeline. So altogether, and to the LP, it would be about a 20 IRR and a 1.7 multiple.
And that's on a 3-year hold.
Correct.
Too. And then I think one thing too to note, when we're talking about 10.7% appreciation and the market being 14 plus, like that's, when we measured the market one, not market appreciation, not every deal necessarily was a deal where someone's adding value.
Mm-hmm.
So we're underwriting this, realistically pretty, like quite conservatively. If you think about, we have like an entire value add strategy, and then we run out our, our model, and we're assuming, let's just round it, 11% appreciation when just all the deals that sold divided by their original, price last time it sold is averaging 14% a year. Like this, we're definitely underwriting this conservatively. Same thing with the rents. If we're doing 5% a year, the market, I keep coming back to where, we calced our Yardi data in the 10-year, trailing average, it's 8.6%. The 5-year, it's 11. So, we're picking that because it's, it's just it feels conservative, but I feel like we're definitely why we're going to beat the rents.
Yeah.
Cap rate's going to be the $1 million question now with interest rates going up for, the next, like for the foreseeable future. That'll be the conversation. But I think at least, especially on this deal, like we have so much rent growth here, between the renovation and then just the market where we'll be, we'll be looking good. It was interesting also too hearing you just read off the cap rates. I was listening to a podcast this morning. I don't know. I just really like real estate apparently. Where when I was having breakfast, I'll listen to a different real estate.
To your own podcast?
No, that was that would be good. That's funny. No, it's actually it's the Old Capital podcast.
Okay.
Yeah, Paul Peoples, Michael Becker. Yeah, they're in Dallas, and Paul Peoples is a lender. Michael Becker, he's a principal doing multifamily investing, and they were talking about Austin and Dallas and the cap rates. And there, a big thing obviously is in Texas that taxes change annually, and then they don't know your sale price because it's non-disclosure state, but they chase hard. They raise it so much they basically force you to disclose it, because then they raise it. If you paid 10 million, they move you to 12 million, and then you have to go to the court and say, hey, I only paid 10 million, this is messed up. And then then hopefully get it down to 90 or 95% of what you paid after filing a lawsuit and all that. But anyways, their tax adjusted market cap rate on deals in Austin and Dallas, it was, I don't have the exact number, but they were saying it was like, this is where they're stabilizing to. It was like in the low threes. So it would be like you're going in at a 2 something, like tax adjusted, obviously, because our rents are whatever, 10-20% below market.
Mm-hmm.
And then, you hit your year one pro forma rents and you'll be in at a low 3 cap. And they're talking about, this was maybe like a month old, and they're talking about, then that's crazy. Rates are at 4. Like you really got to believe the rent growth is there. And in these places like Phoenix or Arizona, Texas, Florida, there's such a, like, everyone on that podcast really believed the rent growth is just going to be so strong, where I have all these anecdotes where it's 10% plus on all their trade outs, and they're sending out renewals at 10% rent bumps, and everyone's signing it. And their whole thing is like, this is not just like some cyclical thing. And right now it's like, it's like the stock market or whatever, goes up and down. And this is like a secular shift where it's different. Everyone was moving, wanted to move to New York and California before, and now it's a total different deal. People graduate college and they're thinking, okay, should I go to Austin, Texas, or Miami, or Phoenix, or like where it's a totally different world. And that's not like a temporary thing. This is going to be like this for the foreseeable future.
Yeah.
So it's interesting to hear you just say the cap rates, because I'm like, wow, these feel really, really high, especially in Phoenix. They don't adjust the taxes when you sell. So you could be, they're kind of guessing almost, here's what my stabilized cap rate's going to be, because they don't know their tax number. We do. Like the cap on what the limited value can change in Arizona is it's 5% a year. So we just underwrite it hitting the max every year just to be conservative. But so we do know our number. So then like when these are, this feels really high to stabilize at a 4.9, and then I know we're going into the 4.7, but that's like my Starbucks example, almost irrelevant in a way. Like this deal, we see a lot of deals selling where the going in cap rate's a 2 and they stabilize to less than a 4.7, so that's, and apparently that's what all of Texas is like as well.
Yeah.
So cool. Well, yeah, that's, maybe back to the deal. Let's about another podcast and market.
Yeah. Yeah. So, we had a verbal agreement to do the deal at 5.7 million. And, actually, I didn't share this when I wrote the LOI, but I had actually written in the LOI that upon expiration of the due diligence period, we would release to the seller the earnest money deposit. And I think it was 50,000, 100,000, in that
the
range.
Earnest money amount.
Yes.
Yeah. Yeah. I think it was 100. We should
Yeah.
look it up. Yeah. No. Yeah. I think it was 100, and then additional was 250. I'll look it up. Keep going.
Yeah. So we had evaluated a number of deals in Phoenix already to this point, and a number of the brokers had said, because the market has been so aggressive, it's the most liquid it's ever been. A lot of these deals, the earnest money is released to the seller day one and is non-refundable. We actually did that for another deal that we just closed on, but I had written in that it would be released to the seller upon expiration of due diligence, which we had like a 15-day period or 15-day period. But just because it's in the market that you release the earnest money deposit to the seller, that's not necessarily something that you should just include in the LOI without the broker or seller countering first that it should be. So I think that's something important to know. And, it's not something that, we had actually talked about before I sent in the LOI. So, you brought that up, and it was a minor, it was a mistake, but ended up being all right because we still closed on the deal.
Yeah, and I did check the LOI before it went out, but I guess I just looked at the amounts, where yeah, because it's extremely common for earnest money to be released in the entire Sun Belt on multifamily and on industrial. It's and in apparently I heard someone chiming in on Twitter or somewhere, like in New York, it's always been like this in New York City. There's
Hmm.
not anybody putting things under contract with not any uh with some, you need some amount of non-refundable, and it's probably like that in California. It's like that in California too. But anyways, yeah. So then it's not. It really depends on the deal, on if the earnest money would be released, and then also if all of it would be released. Because
Hmm.
something else that I've heard people talk about is maybe the earnest money is 100,000, but they're only releasing 25 of it.
Hmm.
Or and also, when is it released? After due diligence, that's not really that big a deal at this where the market's at. There's people who have to put up a whole deposit, have it non-refundable, and released immediately. And then the only way they could back out if there's like a title issue. And some deals, they're like, "Here's our old title report." Like you have to. There's no way you can back out now.
Hmm.
So, that. Yeah, and I pulled it up. It was 100,000 initial. I'm looking at the signed purchase and sale contract. 100,000 initial, and then 250,000. Because we extended it 30 days to do the extension. So yeah, we had 350 up. Download our 100 plus page passive investing guidebook today at riseinvest.com/downloads. Accredited investors can sign up for our multifamily investment opportunities by hitting the Invest Now button on our website. Now back to the show. Um, so also, that's a lot of earnest money for a deal this size too. I mean,
Hmm.
usually in a lot of markets, 2% of purchase is normal. So that would be, just like a touch over 100 grand. Um, so then well, I guess actually with the extension, the only thing that's allowed is that extension was way more than normal.
Hmm.
But that was something we went through when we were doing the LOI. You can't always get an extension written in there, and I guess I'll explain that since now we're talking about it. But our LOI was a 60-day closing, so 60 days from signing the purchase contract, and then if we at a buyer's option, we could extend the closing date another 30 days if we put up additional non-refundable earnest money. A lot of deals people just cross out and say, I want to close in 60 days. I don't want to give an extension. So that was a lot of money, but I guess on one hand we were happy just to have it, so
Hmm.
then that, to me, it's been my experience. It's like, I don't know, maybe just to throw out a percentage, like a quarter of the sellers are just like, we don't want to have that. And then maybe another quarter is like, they don't care at all. So then you
Hmm.
can extend it for, 25 grand or something.
Hmm.
And then maybe the other half, they, kind of on the fence and do care about it if there's like enough money up. So,
Hmm. And if they want to do a 1031 exchange, which we were told that the seller was interested in doing, I don't know if they ended up actually executing something, but I think that was the reason why they wanted that larger deposit for the
which,
extension.
yeah, which makes sense because at a certain point, she's going to find a deal, and then she's going on her deal. And if it's in Arizona, she's going to be non refundable on something with her
Hmm.
money released. So then
Yeah.
she's looking at this going, I don't want to, have these guys back out. And then, so I really need to, have it tied up strongly by then. So,
Hmm. Yeah. So yeah, and like we had the agreement to do the deal at 5.7 million. And the broker said he was going to send over the Arizona form contract, which the seller herself, she was actually a licensed realtor in Arizona, just mostly selling single family houses and things like that. That was the contract she was used to. So the broker said, "Hey, I'm going to get this signed up. I'm going to get the seller's signature and send it over to you." And, we had no experience using this contract before. So, it's a good idea to not sign a contract that you don't know or you haven't read or you don't really know the nuances. So we had to scramble a little bit just because, like I had said before, they said take it or leave it with this 5.7 million offer, or we're going to take it to a call for offers. Um, so, we scrambled a little bit, and I talked to a few lawyers in Arizona to see what they thought about the contract. And, actually, when I started working for you, we had a deal under contract in Chicago, and that was using the Illinois form contract. And baked into that Illinois form contract is an attorney review period, which you get the contract signed up, and then I think you have like 15 days for the attorney to create like modifications and comments and things like that. But that didn't exist with the Arizona form contract. And I think we were like, this was right around like Thanksgiving time. So a lot of the lawyer, like, we're signing off for Thanksgiving. I'm probably not going to be able to get like these modifications to you in like over a week's time. And, we're backed up against a CFO now. So, what ended up happening, we learned that it's going to be difficult to modify. There's no attorney review period. By the time I'd figured all this out, I got a signed contract from the broker with the seller's signature on it. And, I told the broker, like, hey, I've been talking to a few people, and like, it's going to be difficult to modify. We need to figure out something else. And obviously, when the broker gives a signed contract over to you, when you have a verbal agreement to get the deal done at this purchase price, um, and say, you can't do it with this contract, he's probably going to be, pretty upset about that.
Yeah, and
that,
so with the seller.
yeah. So yeah, I mean, that was a little bit of a hiccup, but and they were upset, but like we ironed it out, and we're actually we were in the process of, we had actually just signed another contract for another deal, Desert Palms, to do that deal. And that was a contract that the seller had used. It was a good contract. We had just signed it. We had put in our modifications. So our solution was like, hey, we got a good contract that we just used. Very similar building. It's another, guy who's in Arizona and who does deals just like this seller. We think it's a good contract. Let's try to use it. So we proposed to use that, and we were able to get the deal executed before the CFO date.
Yeah, and CFO to call for offers. And one thing that I find interesting here in the explanation around the contract is just sort of like how important like sales is in general. Where because I have remember just in my head telling you like, here's how to like convince them to use it. Like, tell them the contract is actually not from us; it's from the seller of that deal. Because like that's a good selling point to them. As the seller of this building we're trying to buy, like, oh, it's not like your super buyer favorable contract. It's like it actually came from a seller, and we already worked through all the usual changes. So you might as well call it like like maybe we try to call it like a form contract from that guy's attorney, like where we were kind of had to pitch the contract almost like we just used it. It was actually not ours, and it seemed really fair, and the seller obviously liked it because they sent it to us. Like, let's use this, and then they went for it. But yeah, the whole time was they're pushing hard because they to cancel the call for offers. I think they had announced a date, so then you have to then if people are gonna submit, you need to tell them like it actually got taken off the market, and they disengage. And if it's they really wanted to know like this thing's like fully signed up and not a deal that's gonna like fall apart when we go to try to negotiate a purchase contract. So I get their motivation, and then it was trying to think how to like sell them on this
Yeah.
thing, basically. So
Yeah, definitely. So yeah, we ended up getting the deal signed up, and I realized when we were talking about the underwriting, I didn't discuss like what our loan assumptions were, which we went to a bank that we had used before. We had just closed another deal in Phoenix with this bank. So we were underwriting. We had the purchase price of 5.7 million. We had about another 400,000 on top of that in renovation dollars. So we got a loan amount for 4.8 million roughly, which is about a 80% loan to cost. So initial funding would be about 4.5 million upfront, and then with future funding up to 400,000. Origination fee of 75 basis points. 5-year term, fixed rate, 3.5%, 12 months of interest only, and then a prepayment penalty of 3% in the first year, 1% in the second year, and then zero after that. So good for our I guess short term value add execution where we wouldn't necessarily be locked into a loan where we have to pay an expensive prepayment penalty after 2, 3, 4 years, whatever, however long we end up holding the asset.
Right. And this is something I've said, probably this is closing in on the eighth time I might have said this on the podcast, but it is so important where, like for this, the prepay structure, where you really want to match up your loan with your business plan. And our plan is a 3-year hold. Obviously, we might decide, okay, hey, let's sell it in year 2. We finished our renovation quicker, or let's say the rents are still growing at 14% a year. Let's keep this for 5 years. And why would we sell it while there's still all this growth? But we have now set up our loan where in any of those scenarios that I just laid out, 2, 3, 5 years, the most we're going to pay in prepay is 1%. And so like it's really important because I think one thing too, you could get, let's just take like the worst case kind of loan, like you do a yield maintenance prepay. So that you need to, how there's an actual calculation for it, but how I think of it, you got to maintain the lender's yield. So you got to basically pay all your interest on the loan through the term minus what they could make if they invested it in treasuries. And there's some discounting going in on that. But basically, I've heard people paying prepays when it's yield maintenance 20%, 10%.
Wow.
We've had stuff quoted where, it's like a $8 million loan. And it's, this is before I'm like, just no more yield maintenance. And, and it'd be like, what's the prepay on that? And it'd be like, it's $1 million, or $1.5 million. And also too, that again, that limits your buyer pool. In 2020, one of the deals, the one we bought in January, then this one, I think, and then one in February. We bought 3 of the 4 deals we bought that year were loan assumption deals. And a big part of that was we thought we were getting a good deal because we're paying a kind of like a lower number for the headache of taking on this loan. Some of them were, or I guess I should say, we underwrote to what worked for us. And odds are, if that building, I'll just say it differently, we offered a price that made sense for us. And odds are, if these buildings were offered free and clear with no loan assumptions, just like we were talking about with the Airbnbs, the buyer pool's bigger. Odds are someone's willing to pay more than us. But one of the loans was the interest rate was high. One, the leverage was high. So not every buyer is going to want that. And then so then like and then the other one, the rate was low and the LTV was like in the 60s. So that's a loan where like a lot of people would want, but not everybody. Maybe the highest payer would have tried to do a 80%, Freddie Fannie loan or something. And then it wouldn't have worked out. But yeah, so that's just so important because then we see that as a buyer where some of these deals, we think, hey, we're getting a great deal here. It's because the buyer pool got limited. And another thing that I actually just kind of calced it out because it's just, this is like simple math and not exactly right because you're amortizing your loan. But another way I'm going to start thinking about this just for myself is, let's say you did a step down prepay on like a loan like this, a 5-year, and it started out 5% year 1, 4% year 2, 3% year 3, and then 2, then 1. On a loan like this, let's say we did that prepay structure and then we held it for 3 years. You paid 3.5% every year on your normal interest rate. Then at the end, you pay an extra 3% on the way out. It's not exactly right because what I'll say next, because you're amortizing the principal down, but it's basically like you paid 4.5% because you paid 3% on the way out. 3 divided by 1. 3% on the way out divided by the 3 years equals 1% extra each year. It's like you paid 4.5. So then even though you were paying 3.5, you got to pay almost like a whole year's interest on the way out. So then you start realizing that, and then you'd go like, hey, I would even pay a higher rate to get this prepay if we needed, because I'm better off if let's say we had to pay a 3.7% rate, to get a flexible prepay. Well, that's cheaper than 4.5 on this like basic math thing. So this was a prepay that I negotiated with the bank, and it just was copying the one that I've done with Freddie Mac like 10 times because this is the lenders they don't want to make a loan and then get like paid off in like a year. So then the
Mm-hmm.
3% protects them from that. And then, so that's like such an important point that I just want to keep harping on that, because that once you realize that, you start almost looking at this backwards in a way in terms of the order. Like, hey, it's a 3-year loan. Like, what's our prepay? What's our rate? Like, what's the leverage? So that's, that might have been the only thing we negotiated on the whole term sheet. I don't know if I negotiated the rate actually. And so it would have, this to me, it was almost you're negotiating the wrong thing if you're going to do a 3-year hold and you got offered a high prepay. Just tell them,
Mm-hmm.
hey, that rate's good, but I want this flexible prepay.
Yeah.
Save more money. Okay, what do we do for the equity structure?
Yeah. So for equity, we did the syndication with high net worth investors, families, friends. I think we ended up with 14 total investors, including me.
Yeah, and actually, that's one thing that I'm is really cool. It ended up where everybody who worked here invested money in the deal,
Hmm.
and some of them their parents did.
Yeah.
So then, like, that's really cool. I would have never thought that would have happened. And not it's really says something about the deals where people are working on it, or like you know you're modeling the deal, you're doing it, and then the guy sitting next to you is like, hey, we should get like money in this and like get a share. And same thing with just so it's interesting to see where yeah, so out of the 14 investors, I mean, six, 5 or so of those were the deal team, so that's um interesting to see play out. I'm proud of that.
Yeah. And yeah, and that's definitely good to see from a GP where, they got their skin in the game and they believe in the deal in themselves. They're willing to put their own money. So yeah, it was good. And I think, total equity amount, about 1.6, 1.7 million. Waterfall to the investors. We had an 8% preferred return, where we pay the accrual and then we'll pay back any capital before we start to earn a promote. Then a 70-30 split above an 8%, and that's up to a 12% return. And then it's 50-50 thereafter.
Nice. And then you said that the pay accrual really, so like on the pref, if you can't pay it in, let's say the first year the cash flow is 5 and that's what you distribute, the difference between the 8 and the 5 that gets accrued, so tacked on. So then you're building up a balance that all that needs to be paid, where it's the equivalent to 8% a year. And also, if you whatever that shortfall is, it's building, that's also earning. It's building. I'll just use the term interest. It's building interest at 8% on itself. So then you're getting what amounts to, after you get your money back, that's a 8 IRR. So it's also discounted for time. So then you get your 8%. That's how that works. Because then, just to clarify, it's compounding and
Mm-hmm.
accruing. Cool. What about, where do you want to go next?
Yeah, I think we should talk about the due diligence process, which we did a little bit of homework up front, with these older deals and with, so many of them um having, non-refundable day one earnest money. You really want to do some due diligence up front in terms of like title, environmental, things like that. So one of the things that we actually have been doing with all our deals is we subscribe to a service called EDR, and they provide like a neighborhood environmental report where it's, a series of like government searches, and then like you have like a environmental personnel, like you get their opinion on the deal itself, whether it's at low risk or high risk for any environmental concerns. That's good to know up front, because let's say we get through the deal and the seller has our earnest money and we find out that there's a leaking, underground storage tank underneath the property, and that's going to be a big concern. Well, like with this EDR report, we would have known that up front. So that was something that we had done that was useful. And then in terms of like deliverables, we maintain a checklist of all the items that we expect to receive from the seller, which is always good because, you know, um, it wasn't really an issue with this broker. They were very well organized. I remember you saying like,
It's the
this is the
most organ.
best checklist I've ever seen, or it was very organized where they put the documents, numbered. in like a Dropbox numbered with, the exact items that we had requested per the PSA. So it was really nice to have that. Sometimes you don't always get that. Sometimes, you might get a rent roll sent over to you in one email and then, T12 sent in another email. So it was really nice to have that. But, we also maintain our internal checklist for what we should expect to see. So that's good to make sure, you don't lose anything like slips through the cracks. So, I'd say the due diligence process was, it's pretty straightforward. We performed a lease audit, made sure, the rents that were presented on the rent roll, and then the lease start and lease expiration dates and security deposits. Make sure that's all verified per like the actual lease documents, where we have a signature from the seller and the tenant themselves. Go through like utility invoices, making sure that we're underwriting utilities properly, covering water, sewer, trash, electric, gas, and then also going like through historic financials, doing things like you have something
No,
to say.
I'm smiling just as you're listing these things. I'm thinking of all the crazy things I've seen over the years. Where, like, when you're talking about checking for the lease signatures, when I was buying 2032 and 2042 as Pierce, none of the leases were countersigned by the owner. So, like, you didn't to have a valid contract, you need to have both parties sign and have it delivered back to them.
Hmm.
So, because let's say you have a contract and I sign it and give it to you, you could sign it and then never give it back to me, and then then at that point it's not, maybe in some instances it would be a valid contract, I guess. Check with your attorney. I'm not an attorney, and these were definitely not valid contracts because it wasn't even signed. So that's why I
Yeah.
was smiling. Where I'm like, yeah, I remember that deal where they didn't sign it, or this other deal where there was just pulling teeth getting information, and it would just be like I mean, some of these things, it's like, here's our checklist, and then you never. It's like pulling teeth to get the info, and the way we always send stuff, and everyone comments to it, where I'm detailed, and then I've ended up hiring people who are also detailed. So we're sending things that are in like a link to a folder on Dropbox or Box, and if you send us a checklist and we send you that back, we'll rename the file or the folder with the same name and number you had. So if number one was leases, if we're selling, we would have a folder, or refinancing, it would say one period space leases, and then all the leases would be in there with the files named in a way where it would make some kind of sense.
Hmm.
And this was the first deal I've ever been a part of where someone sent us information like that, or maybe the first thing ever in my life. So that's why it was like, let's tell Kellyanne, like, this is the best thing we've seen. Like, this is the best we've ever been sent info before. So definitely, people like to be appreciated. They're doing
Hmm.
something right. So
Yeah, definitely. Um, and yeah, I think one of the biggest parts to the due diligence process is you're buying an actual property that exists, brick and mortar. You're not buying a stock that just kind of exists through a screen, or, so you actually need to hire consultants to do a physical inspection of the property. And you walk through the units, you go on the rooftop, you check all the building systems, whether it's the HVACs, water heaters. You'll send like a camera through the sewer. You'll have termite inspectors go with you. So it's a very robust, process to make sure the property's in good standing. Maybe there's a few things here and there that are broken, but that can be fixed. But it's a very important part of the process. And with this being an older deal, like 1970s vintage, um, and especially for a value add deal, it's always really important to underwrite contingency when you're looking at these deals, because it's not all about swapping out a countertop, or putting in new cabinets and then getting a premium on top of that. You know, you have to check the actual guts of the building, whether it's the plumbing, electric, the roof. And it's a good thing that we did, because, one of the first things that we discovered, like while I was there on the site, was the electrical panels for the units. They're all Federal Pacific stab lock, which are a fire hazard, and we realized that they'd all need to be replaced. Another thing that popped up was that there was a crack in the sewer line. We also saw that there was, a crack, like some pool foundation issues as well. which we had seen like the first time we had actually just done like the first site visit just to tour the property for the very first time. But the electrical panels, the crack in the sewer, like those aren't things that are going to be immediately obvious to you because
Well, I think on the electrical panel that I did notice that when we walked it. I
Mhm.
always look at the panels, and it's almost like a famous panel in a way that like it's in loan documents by name. Like if you have it, not every loan, but some, like you are agreeing to replace it within 12 months. And so that because yeah, in this deal we had and maybe I never told you that. I mean, we have money in our spreadsheet,
Yeah.
either I think for the unit electric, like 22,000 bucks or whatever it was. That was for the panels, I thought.
Yeah,
Is
and
that
like yeah, we had budgeted in that cuz we were kind of going through the same thing with another one of our properties where, you know, it's not just going to be as easy as installing a washer dryer into a unit. You got to make sure that like the electrical can support something such as this. So that's something that we budgeted in for another one of our deals. So yeah, I mean it's good to assume that contingency on top of it because yeah, like I said, like not everything's just about installing in a washer dryer. That's it, or just swapping out um, cabinets and countertops. You got to make sure that the building actually works and it can actually be suited to fit your business plan.
right? And I would actually say, really, on any deal you buy, there is capex to do. I've bought brand
Mm-hmm.
new buildings, or buildings that are 2, 3 years old, and there's still stuff to do.
Mm-hmm.
So yeah, on a deal this size, I would, if someone told me that's perfect, there's nothing to do, I'd still put 50,000 in for needed capex until I saw otherwise. Because it's
Mm-hmm.
just so common where you'll go and it's renovated, then you go there, there's like 30 grand of pool work looking at you,
Mm-hmm.
and then there's still, you're going to find out stuff in your inspection. Then you do the inspection and you realize, okay, the sewer is cracked. And then that's so that's like that's why I would go with 50. I've just basically seen that, like happen time and time again. It's happened to me like 40 times basically. So what it feels
Mm-hmm.
like. So it's interesting comparing the prices on the sewers. We had actually at the same time, not when we were buying it, but we fixed the sewer here and at another building I own. It's interesting. Basically, the same project. The price in Chicago to go through the concrete and just fix like a one small area where it broke was 7,000, and then our price in Phoenix is $4,200. It's the same work,
Mm-hmm.
and so it's interesting the price difference as well on some of these things that I can kind of compare from where I'm sitting every day.
Yeah.
It's interesting.
Yeah. And I think to that end too, you know, I think there are a number of buyers who may overreact to something like that because I think initially we thought maybe the crack in the sewer would be underneath one of the actual apartment units, which that means you got to kick the tenant out, you got to rip the floor out, and then redo the sewer, then put new flooring on, and it could have been a mess. But we want to stay true to the broker and the seller, and we want to make sure that we're getting a deal done. We're doing everything that we can, and that helps with reputation. It helps with deal flow in the future where, if you tell the broker that there's things going on at the property, but you're going to do whatever you can to make sure that we close and we get a deal done, they'll appreciate that.
Yeah, definitely. Yeah, and I think too, some of these things too, they come up in where maybe if it was my first deal and I heard the sewers broke, I'd be freaking out, But I mean, this is probably like the fifth sewer I've had to fix,
Hmm.
and I mean, at that one, I mean, I had two broken at the same time, like, so it's like, it's not when we actually fixed it. Now it's like, this isn't even the only sewer that's broken. So if you tell me that, I'm not freaking out basically at this point where maybe on the first one I would be.
Hmm.
So, because yeah, because you heard it was broken first and you told me, and it was like, well, we're already renovating the unit, if it's
Yeah.
under a unit or it's going to just be out in the parking lot or rocks here. It's one thing that's different. It's not out in the grass. There's not a lot of grass down there. So it's like, it's not that big a deal. And, yeah, and it just depends what, how it was priced, how big the problem was. That's a pretty minor problem. If, I was looking at a deal once where the sewer was broken in over 20 places.
Wow.
That deal I canceled because that was, I don't know, 100,000. I mean, at least to redo that sewer. And that was way beyond what I had in my spreadsheet. And then wasn't, and the market's strong in Chicago too. That deal was here, and they weren't weren't interested in doing anything, so canceled it. So not doesn't you don't just skate past every problem. That's not the point. But like stuff that is like truly not that big a deal, or you should be having some numbers in your spreadsheet already, or budget or whatever you're making for things like this, especially if some of them you can kind of see, like that pool didn't look new. It looked, like 50 years old, or 40, so we weren't thinking we were just going to buy some new lawn chairs and some new chairs and be done with it.
Mm-hmm.
More to do there. Cool. Where do you want to go next?
I guess we'll talk about, integrating the property management, which, we had interviewed, a long list of property managers in the Phoenix metro. And, the one that we actually ended up going with, they have thousands of units under management. They've conducted thousands of like unit interior renovations. So it's really nice because, hey, we're located in Chicago, and we kind of need that fully integrated property management company who can conduct these renovations. We're not, on the phone, like going back and forth between vendors and like trying to, we're in Chicago and they're in Phoenix. So it's nice to have, a property management company that does have that like construction and design team where they can conduct a lot of these renovations and, take care of the property where, a lot of it falls on their shoulders and they look to us for direction. But when it comes time to like actually execute on things, like we have boots on the ground in Phoenix who can conduct these.
Yeah, because if we were trying to oversee a contractor just on our own from here, it would be a disaster where you got to get someone local then to run it. Where you can't construction, you need to be there, you need to see it. So that's where actually how we ended up on the management company. It's called Cam Properties that we're using, where we were touring another deal, the something blue, what was it, Arroyo, or we were at a deal in Phoenix that they manage and were renovating. And I've seen a lot of construction, and I remember looking at this laundry closet they were building out, and I was just like, this is the nicest laundry closet I've ever seen in an apartment building, to be honest. I mean, I've seen, I guess, nicer ones, but those are in like, $1 million homes, basically. Like for like they replaced all the drywall, the connections were really good. And then they had this breather valve on top for the venting of the drain in there. And it was like, this is the best laundry hookup install I've ever seen in my life. Let's talk to these folks. And that's how we got on them, actually being in the market. And then, once we met them, we were super impressed with everything.
Mm-hmm.
And funny story too, actually, this week on Wednesday, we were talking to our regional. So I guess shout out to Crew Johnston, where we were our regional at Cam, where he was like, "Do you have a podcast?" And I was, it's not something you just like tell people like, "Hey, nice to meet you, Crew. I just want to let you know I got a podcast." And I was like, "Yeah, I do. Like, how do you, I was very curious how I heard about it, and I was actually really happy he was watching some episodes, and he said he found it on YouTube, but not like searching for it, just like suggested video. So I was like, all right, now, so it's getting out there. So kind of funny. So I was really happy to hear that, where that's, also funny that I guess maybe I shouldn't, we should have it somewhere else where it's more obvious to find than if people working with us haven't even heard of it. But anyways, cool. Want to talk about the closing, and then let's wrap up.
Yeah, sure. So closing, we closed on back-to-back days with Desert Palms, and so it was a lot going on, but we maintain an internal checklist and made sure that everything was getting done properly. For the settlement statement, that's something that we'll always like recreate internally, not just solely rely on title or the attorneys to make sure that these numbers are correct, but basically, we create line by line closing costs, lender costs, rent prorations, real estate tax prorations, security deposits, prepaid rents. And I'd say, of the 4 deals we've closed in Phoenix, probably 3 of them, the prorations were off or the security deposits were off. So, and it would have been like an unfavorable difference to us. So it's really important that, we do that work up front and make sure like, hey, there's not $5,000 in security deposits. There's 9,000.
Right. And something too with these deals, there's a lot of numbers on the settlement statement, and a lot of times you don't get the settlement statement to maybe the day before closing. I bought plenty of deals where you get it the day of closing, And yeah, you don't want to be calculating these things like kind of under like duress, like it's 11 o'clock on the closing day. Why are cutoff times 1 o'clock? How do these look? You want to have calculated that, the day before, or, the earlier the better. And
Hmm.
then then when you get the rent prorations number, you just look at what you already calced and go, actually, I got something different. Here it is. And it's not, or it matches. And then you just spend like a minute looking at it where it's not some big, rushed event. So
Hmm.
what else? Anything you learn on this closing or?
Yeah, I mean, something that you've said basically every closing now is you got to stay on top of everyone. You can't just assume that work is getting done because there might be something that's been completed, like a document that somebody signed, and you ask where it is, and then the document finally gets sent. Um, or just talking with like title, making sure we're in good shape for closing. Like, what else do we need to do? Just like continuously following up to make sure that we're progressing because we've got deadlines to meet, and um, you know if uh, you know the closing is extended by a couple days, maybe you're backed up against your last day where you could get the deal closed. So it's good to make sure that like everybody's progressing well. And one of the things that came up with this deal in particular is that the seller needed to attain like these tax certifications where basically the city certified that these rental taxes were being paid. And this is something that the seller wasn't able to obtain on time. And what we've done for our other deals, because the municipalities in Phoenix are backed up with all these types of requests because there's a lot of deals trading, there's a lot going on, there's a lot of new construction. So they were backed up, so they couldn't get these tax certs. Um, and normally we would have agreed to do like some type of holdback where it says, we're going to hold back whatever, $5,000 in proceeds until you give us these tax certifications. And if we don't receive them within 90 days, like the $5,000 ours. But if you do get them to us, then that will release the 5,000 from escrow. Um, for whatever reason, the seller, they couldn't get them, and they didn't want to do any sort of holdback. So the broker actually agreed to like hold back some of their commission that they were earning. Um, and I think initially we thought like, okay, that's fine. But then, at the end of the day, we told them like, we don't want to hold back any of your commission. Like, you earned it. And I think that's better for the long run because you don't want to mess with like the broker's commissions and like, because that's their livelihood too. Because and it wasn't necessarily like the broker's fault that the seller just wasn't agreeing to something that we had executed for our several other deals. So yeah, and that was one thing, and we needed to sort it out because we were trying to figure that out like the day of closing because our attorneys had sent this holdback agreement, a few days prior, and we weren't making any progress, and we were trying to figure out like what's going on.
Right. And that's one of those decisions where there's like so many factors at play. The seller didn't want to do a holdback because she's saying, I paid it.
Hmm.
Like, I don't have a receipt, but I paid it. I don't want to hold money back. I'm trying to, and two, also when you do holdbacks, then it complicates your 1031. Now that money didn't get exchanged. And so then she's worried about that. The brokers, it got to the point where like the broker's offering like his money just to get this thing finished. But we're also looking at this as buyers as like, I don't remember the exact time, but it was after like noon. It was after 12. And you gotta get these things across the finish line, not by like 5 p.m. because you want to, a lot of times the lenders, they don't send in their money till like all the documents are signed, including the settlement statement. But okay, let's say we would have gone this route. Now we need to sign some sort of contract with the seller, us, and the broker, get everyone to sign it, and then that's another signed document they need to fund. I guess get the money on the settlement statement too, coming out of the broker's fee. So it's more than just like, hey, let's just throw caution to the wind here or something. This is like the person saying they're selling it. They already paid it, so we'll get some goodwill with the seller if we just let it go. Same thing with the broker. We got a lot of goodwill from him, I'm sure, where he agreed to do this. And also to me, it was to a point where it felt kind of ridiculous almost. Where now just to to an agreement. Like now the broker's got to pay. Really, I felt like it should be one of like either buyer or seller. And then also we're taking a risk as a buyer too now, letting this continue to drag on, where I think we were closing this on like the last day we could in the contract. So we keep messing around over like a couple $1,000s or something. And then we all of a sudden lose our $350,000 of earnest money, so that's, so we have more like, kind of like build goodwill, but also just like a risk reward thing where we could have burned up another 2 hours, just kind of trying to get that ironed out. And kind of, I thought like for what, like she keeps saying I paid it. And that's believable. There's things that, we've paid where I'm sure if we need to get a receipt, it's, from a city that's not, that's not that fast, I'd imagine. So cool. Well, yeah, I think that's plenty on the closing. I think then let's, just to bring it home then, like post closing, we're just cranking on our plan now. So we already have that sewer works done, and we have a signed contract on the electrical that's starting, and then pool work, we just signed off on a contract on that. So that's happening, and we're figuring out the in-unit renovation scope, finalizing them. We had them 90% done, let's say, while we're buying it. That's another thing where you need to pull permits for laundry. And so we had the engineers go through while we were under contract. So they're already working on their plans and everything for permits and what they need to submit. So we're cranking on this. So, and then, we have one unit empty right now. So that's going to be our test unit. And, one thing we'll need to figure out, this is like a super minor detail, so it might not even be worth mentioning, but, we want to add dishwashers in these too, some of these. And it's not, adding a dishwasher, it's not just as simple as like, all right, here it is, put it in. Cause that's got to go under a counter. And then like the kitchens already like are fully like laid out. So we have to reconfigure these kitchens. And, so then that, to add the dishwasher and have it look, right, where we want to have, obviously a counter above it and cabinets above. So then what we're doing now, while we're waiting for permits, is that's like the last piece to decide. So we have, actually Cam also has someone who can do layouts. So they're going to lay out every kitchen, including a dishwasher and then a microwave above the range. Cause a lot of these didn't even have a microwave either. So then we're going to have a fully, that's a fully amenitized kitchen here. So that'll be a lift to rents too. But a lot of these minor things, don't be afraid to try to figure them out really early, because we're still working on buying the deal. And while you're doing that, I'm already talking to Campbell. Let's get the engineers in and let's try to get some like standard pictures of every unit. So then when you say, hey, what do you want to do with the floors on unit 5? I just go pull up the pictures and go, hey, those are nice vinyl floors, keep them. Instead of like, what are the floors? Oh, they're vinyl. What color? Where now we have all the pictures we need, people working on plans, and we're off and going. So cool. Well, let's wrap it up there. Thanks again for being on, Evan. Appreciate it.
Yeah, it's a lot of fun.
Great. Nice. Well, yeah. So glad you guys were able to join us talking about this deal. I mean, this was a fun one to get done, and like I said, one that I kind of, I wouldn't have closed if it wasn't for you really. So appreciate it. Thanks.
Yeah, it's going to be a good deal.
All right, great. All right, well, thanks for joining us, and we'll see you on the next episode.
Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com, where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.